Welcome back to Yahoo Finance Live on this jobs report Friday. Again, let me recap these numbers. Jobs on the headline, 850,000 increasing futures. Pop a little bit on this news. Okay, Moody's Analytics Chief Economist Mark Zandi is still with us. Myles Udland is making his triumphant return. He's with us now. And Emily Roland, John Hancock Investment Management Co-Chief Investment Officer, joins us as well. Mark, let me get back to you here, because coming into this report, you were looking for a pretty significant stock market correction. Does this report fuel a potential market correction in any way?
No, and not this particular report. I mean, when I said that, I can't predict a correction today, next week, next quarter. My point was that the market is very highly valued, in my view, stretched and overvalued. And in that kind of situation, it's very vulnerable to anything that doesn't exactly stick the script. And I do think at some point, as the economy continues to improve, as we create more jobs and unemployment starts to decline, we get to full employment, interest rates are going to rise. And when interest rates rise, that's going to put pressure on the highly valued equity market, and a correction is a real possibility. So, I don't think this report per se has any connection with a stock market correction. But if you told me by the end of the year that there was a correction 10, 20%, I'd say, that sounds about right to me.
Emily, we're seeing a pop here in the futures on the heels of this beat, 850,000 jobs added. How do you think the market and investors are looking at this report?
This is the Goldilocks report that the market was looking for today. So you had a nice print here of 850,000 jobs being added. Wage pressures remaining, I wouldn't call them necessarily contained, but surprising here a bit on the downside versus consensus estimates. So this is telling us right now that economic growth is continuing to accelerate here. The jobs market is continuing to heal. We do still have 7 million jobs left to restore here, but we're making progress here in terms of what the Fed has set out to do, which is in order to get unemployment down, they're going to let inflation run a little bit hot here. Not too hot, not too cold. This is just what the market wants, because what it means is that the Fed probably isn't going to shift their plans very much based on what we saw today. We think they're going to continue down this path of being fairly accommodative over the next number of quarters here, likely to announce the start of tapering sometime over the course of the summer and begin that 2022 with liftoff potentially starting in 2023. So today's report doesn't change that message, and it means that risk assets here can continue to rally.
Emily, you heard Mark's concerns about a potential market correction later this year, and you're talking about the Fed coming in relatively soon and tapering its bond purchases. Does that set the table for a market correction?
I agree with Mark. It is amazing to me that we have not seen any volatility in the market really so far this year. The second quarter actually marked the beginning of year 2 of this bull market. And typically what we see is after that huge move that we typically see off the bottom coming out of bear markets, usually year 2 sees a lot more choppiness, potentially consolidation in the market, whatever the issue is, whether it's a mistake by the Fed or some other exogenous factor that creates or puts pressure on markets. And we're just not seeing that yet. What we are starting to see, though, is a little bit of a rotation happening under the surface. And certainly, I think the month of June was really the poster child for that. We started to see areas like growth outperforming value. We started to see the dollar actually strengthen meaningfully, which typically is a sign of a more risk-off market. So what we think it is investors starting to position for the fact that peak economic growth, peak inflation, peak stimulus is probably a thing of the past at this point. Not to say that markets can't keep going higher, not to say that the fundamental support isn't there. It is, but we need to be closely watching this rotation that's playing out under the surface as investors prepare for a mid-cycle environment in which growth and inflationary pressures are more normal.
Mark, what do you think about that? Just the fact that the inflationary pressures, what we're expecting to see going forward, and whether or not peak inflation is a thing of the past?
It's not over yet. I mean, these heightened inflationary pressures are going to stick around probably through the end of the year. But by this time next year, yeah, I think we'll start to see inflation moderate, come back in, be more consistent with the kind of long run 2% inflation target that the Fed has. But between now and then, and certainly over the next few months, there's still a lot of things to work through. Just like in the labor market, getting all those people back to work, it's going to take some time to get global supply chains all sorted out. For factories to turn on the lights and ramp up production, to just get the supply side of the global economy back into full gear. That's just going to take a bit of time, but it will. That's going to happen. These higher prices are a big incentive to do that, right? Because companies can make a lot of money at these prices, so they have a lot of incentive to get things going here, and they will. But it'll take a bit of time. So I think these inflationary pressures will be with us through the summer into the fall, but by this time next year, yeah, I think the inflationary pressures will start to abate.
And, Emily, just going back to that comment you made earlier about the Goldilocks report, and, we're coming off the first half of the year, the S&P is up 14%. I think there was a lot of eventfulness within that 14%, but ultimately you take that and you run most years. What do you see for the second half of this year in terms of the market's reaction to this kind of data? In some ways, I think reports like this are what has been baked in over the last several months, but how are you seeing the setup here for the second half?
Yeah, it's a great question, Myles, because the market's reaction to data has been somewhat counterintuitive, especially over the last few weeks. We just saw some of the hottest inflation prints that we've seen in almost 30 years, whether it's prices paid via the ISM index yesterday or the Fed's preferred measure, core PCE, coming in a couple of weeks ago at the highest level since the early 1990s. And the bond market barely flinched. And the reason for that is that these inflationary pressures, to your point, had been very much baked in. So that's one reason that we actually see limited upside for the 10-year Treasury at this point. We went from a high of 174 in the beginning of the quarter down to the mid 140s today. And we think that makes a lot of sense given these more modest expectations for economic growth. So not necessarily a bad thing as far as markets go. We do still think, though, that equities are going to need to do more of the heavy lifting coming into the back half of the year. Rates remain exceptionally low, as we all know. We don't think that ends based on our expectations for growth. Again, what we want to do here is we want to be positioned with some value for further upside to potential. And to Mark's point, we are going to see inflationary pressures continue over the next couple of quarters, which could aid more cyclical areas of the market, which are more represented in the value side. But we want to start positioning for these mid-cycle dynamics in which fundamentals, which we've kind of forgotten about over the last year, actually start to re-enter the spotlight here as macroeconomic factors sort of fade to the back a little bit here. So quality growth, we think, is going to be the most important part of the market for the second half of the year.
Well, with all that said, bring on the July jobs report. It will be here sooner than sooner than we want it. Let's leave it there. Moody's Analytics Chief Economist Mark Zandi, good to see you. Emily, Roland, John Hancock, Investment Management Co-Chief Investment Officer, always good to see you as well. Have a great July 4th weekend.
Take care.